Ever wondered how income tax works in India? Well, you're about to find out. Income tax is a financial charge or levy that a government imposes on its citizens to fund public expenditures. It's a key component of a nation's economy, driving growth and ensuring societal welfare. Now, let's talk about the Indian income tax system. It's a comprehensive, multi-tiered system, which means it's progressive in nature. In other words, the more you earn, the more you pay. This approach ensures a fair distribution of the tax burden and encourages economic balance. The Indian income tax system is not merely about paying taxes. It involves understanding tax slabs, calculating your taxable income, filing your income tax return, and of course, knowing how your hard-earned money contributes to the nation's development. So, are you ready to dive into the world of Indian income tax? Now, the first thing you need to understand about income tax in India are the tax slabs. Let's break it down. Indian tax laws categorize taxpayers into three primary tax slabs based on their age and type of income. These are individuals below 60 years, senior citizens aged between 60 and 80 years, and super senior citizens who are 80 years and above. So, how does the rate of tax vary for each slab? Well, for individuals below 60 years, there's no tax for income up to 2.5 lakh rupees. Between 2.5 to 5 lakh rupees, the tax rate is 5%. From 5 to 10 lakh, it's 20%, and beyond 10 lakh rupees, it's 30%. Senior citizens enjoy a slightly relaxed tax structure. There's no tax for income up to 3 lakh rupees. And for income between 3 to 5 lakh, the rate is 5%. Beyond 5 lakh, the rates are the same as those of the younger folks. Super senior citizens get an even bigger break. They pay no tax on income up to 5 lakh rupees, and beyond that, the rates are similar to the other categories. This tiered system, where tax rates increase with income, makes our tax system progressive. It's all about equity, ensuring that those who earn more contribute more towards the nation's development. Now that you know about the tax slabs, let's move on to the next step. Now, how do you calculate the tax on your income? Let's find out. To begin with, the first step is to determine your annual income. This includes all sources of income such as salary, property rent, and any other earnings. For our example, let's assume an annual income of 11 lakh rupees. Once you have determined your total income, you subtract the deductions. These deductions could be under various sections of the Income Tax Act. For instance, Section 80C allows deductions up to 1.5 lakh rupees for certain investments and expenses. Let's say you have deductions worth 1 lakh rupees. To find your taxable income, you subtract these deductions from your total income. So in our example, the taxable income would be 11 lakh rupees minus 1 lakh rupees, which equals 10 lakh rupees. Now, this is where the tax slabs come into play. For the fiscal year 2024 to 2025, the tax slabs are as follows. No tax for income up to 2.5 lakh rupees, 5% tax for income between 2.5 to 5 lakh rupees, 20% for income between 5 to 10 lakh rupees, and 30% for income above 10 lakh rupees. Applying these slabs to our example, the first 2.5 lakh of the taxable income is tax-free. The next 2.5 lakh rupees are taxed at 5%, which equals 12,500 rupees. The remaining 5 lakh rupees is taxed at 20%, which equals 1 lakh rupees. So add up these two amounts, 12,500 plus 1 lakh rupees, and the total tax payable comes to 1 lakh 12,500 rupees. Remember, we've used a simple example here. In reality, tax calculation may involve other factors such as cess, rebate, and other deductions. Always consult with a tax professional or use a reliable tax calculator to ensure accuracy. And that's how you calculate your income tax. But what happens next? Once you've calculated your tax, the next step is to file your income tax return. Imagine it like this. You've prepared a delicious meal and now it's time to serve it. You wouldn't just leave it in the kitchen, right? Similarly, calculating your tax is just the first step. The main course is filing your income tax return. So, how do you serve this main course? Well, in India, we use different forms to file our income tax returns, depending on our income source. For instance, salaried individuals use Form ITR-1 or Sahaj, while the self-employed or business owners use Form ITR-4. Next comes the deadline. The due date for filing income tax returns in India is generally July 31st of the assessment year. But don't worry if you miss that date. You still have a window till March 31st of the next fiscal year to file a belated return. However, it's not a free ride. There are penalties for late filing. If you file your returns after the deadline but before December 31st, you may face a penalty of 5,000 rupees. If you file after December 31st, the penalty can go up to 10,000 rupees. So remember to file your returns on time. It's like serving the meal while it's hot. You wouldn't want to pay extra for a delayed service, would you? And voila, you've successfully filed your income tax return. So that's a wrap on how income tax works in India. We've journeyed together through the labyrinth of the Indian income tax system, and hopefully it's a little less daunting now. We started with a broad overview of income tax, explaining it as a percentage of your income that you pay to the government for the betterment of the nation's infrastructure and services. We then dove into the tax slabs. Remember, these are the brackets that determine the percentage of your income that you're obliged to pay as tax based on your annual income. Next, we tackled the seemingly complex process of tax calculation. But as we discovered, it's just about breaking down your total income into its various components and then applying the suitable tax rates. Finally, we demystified the process of filing your income tax return, an essential annual task for every income-earning individual in India. Understanding your tax obligations is not just about being a responsible citizen, but also about making informed financial decisions. Remember, knowledge is power.